Hello and welcome to yet another episode of our ongoing special series brought to you by Mirai Asset. This is a special broadcast where we'll talk about how the current situation has disrupted the way we invest and how we can get the best out of our money. Today, we are going to discuss banking and PSU funds. What are these funds? How are they different from other debt funds? Are they much safer bet compared to those funds? Some of the risks involved. So today we have with us Mr. Mahendra Kumar Jaju, CIO Fixed Income at Mirai Asset Investment Managers. He is a veteran in the field in the financial services space with over 25 years of experience. He is overall responsible for supervising all debt schemes of the Mirai Asset debt funds. So let's get straight into it. So Mr. Jaju, banking and PSU mutual funds have become one of the favorite categories of funds for most debt mutual fund investors. But what exactly differentiates these funds from other mutual fund categories?
Good morning. First of all, if you observe for the last 1.5, 2 years, the single theme that has dominated the investors' mind space is the destruction that has been caused in the credit space. We have seen a series of defaults from many corporates, and that has taken away the return of many of investors for a long time. And then the banking and PSU funds invest primarily in the banks and the public sector bonds and debentures. And these are the safest segment of the debt universe, so to say, because most of the banks are either owned by the government of India, uh, at least the majority holding, or the private banks are supervised closely by the Reserve Bank. We have seen how, in case of a Yes Bank, to ensure that the depositors did not lose any money. And then public sector enterprises by default are the best grades that you can get because they have the backing of the government of India. And therefore, in an environment where the credit has been the biggest destroyer of returns or wealth for the investors in the fixed income space, the public sector and the banking funds have naturally emerged as the top contender for the investors' allocation. Now, the second factor that comes in consideration is that look, okay, you have made your safety bit, but what about the returns? And because the banking and PSU funds also have the range of duration possibilities, they have also emerged as amongst the best performing funds in a scenario where the interest rates have come down. So, given that, I think the PSU banking fund in this environment clearly is the hot favorite as far as the choosing of different options of the funds are concerned for the investors who are investing for long term and who have the appetite for a bit of volatility for that long term return generation.
Right. So you made it clear that these funds have some relatively safer components, but are these funds really safer compared to other funds?
So, these funds, as per the SEBI guideline, are required to invest at least 80% into the banks and the PSU bonds. Now, the remaining 20% is at the discretion of the fund manager. And in some cases, people out of that 20% have invested in the usual private sector debt. Uh, there, while most have stuck to the highest rated AAA bonds, there are exceptions. So, when the investor is looking at the public, I mean, the PSU banking fund, they have to see what is the 20% allocation that the fund manager is going to do. And then there is an interest rate risk element that comes into play because if the interest rate start rising, then the returns will suffer. So apart from the safety, as I mentioned in my first part also, the returns are also important. We know that there is a limited amount of liquidity in the debt markets, even though most of the PSU and banking papers are liquid. But there are phases where there is limited liquidity in the market and there is a huge transaction cost. Apart from the overall safety of the banking and the PSU papers, one has to also look at how the duration calibration is done in line with the evolving interest rate outlook and where the flexible 20% is being invested. And these are the two factors which at the margin can make a huge difference to the eventual outcome for the investors. So I think these are the two things that the investors need to look at equally carefully.
So 80% component is something that investors should look at when investing. But when it comes to the retail investor, what are some of the other factors that he or she should consider before deciding to invest in banking and PSU funds? in general also, and also when specifically choosing which particular banking and PSU funds he or she should consider. Also, is this the only fund he should consider, or he should just add it to the mix of his portfolio?
Yeah, so I think first of all, the investors has to look at his own investment horizon and the risk appetite, because the BSU and banking fund has a reasonable amount of duration, and therefore it is subject to interest rate fluctuation. In terms of the investor, I think his first step should be to look at his overall investment horizon, risk appetite, and then obviously one cannot put all eggs in one basket. So the money that he has for long-term investment, where he has the appetite for some bit of volatility. There are two primary sources of return in the fixed income space. One is the duration or the interest rate products. The second is the credit risk. Now, we have seen how the credit has not performed in the last couple of years, and with the current situation of an economic lockdown, or a significantly reduced economic activity because of the coronavirus, the credit concerns will continue to be there, and we cannot rule out further accidents in the credit space. So the first step is to eliminate credit risk, and the second step is to still keep alive the possibility of a good return in case the interest rates go down. And then the third step is to minimize your losses when the interest rates begin to turn up. The investor has to allocate to different funds, and I think you asked a very valid question, that just should he invest everything into PSU banking fund, or should he look at a range of funds? I think that the investors will have varying cash flows and varying requirements. So, as is the conventional wisdom, they should look at allocating to PSU banking fund only the money which they have for 2 to 5 year investment horizon. And also again, for individual investor, the circumstances are specific, so they should go with their investment advisor and take a proper advice.
Right. So we know that the current situation has led to kind of subdued returns on bank interest also, and even in equity. So given the decreasing trend of interest in saving banks account and fixed deposits, do you think that these banking and PSU funds can serve as a better alternative as compared to savings bank account?
There is a huge gap between the investors' perception of risk, investors' understanding of risk, vis-a-vis what is the real situation. The second feature about the bank FDs is the tax advantage that the mutual funds have, because if you invest for 3 years, then you are entitled to long-term capital gain, which makes a very significant difference between the realized return on the debt mutual funds versus the bank FDs. So I don't think that they are even comparable. However, as many people have said at different times, that there is a need for a huge investor education in our country, and not only the investor education, but even for the advisors, for the distributors, to get more aware of how these advantages play. Most of the time people are so you know uh, uh, specific about not losing capital or having no volatility even for a day, my return not going into negative zone, etc. When it comes to debt, that out of fear and not necessarily out of proper analysis, they stick to a certain pattern. And then there is a certain theory being propagated in some quarters, that look, if I have to take risk, why will not I take risk in the equity markets, and why would I take risk on the debt side? I think that that's a very poorly constructed theory, because the idea of an investor should be to maximize his return given his risk appetite and investment horizon. We have seen now how the equity markets are giving negative returns over a 3 year or even 5 year horizon, and therefore one should not put all his eggs in one basket. Portfolio asset allocation is a very well established investment theory. Then, secondly, that whatever allocation do to debt, are you going to only focus on the safety of capital, or are you going to look at a risk adjusted return. Now, whenever a sensible person invests, a risk adjusted return approach is the most common. So, let me give you a little example if you give me a minute. If someone has 1 crore to invest and he invests it for a 25-year investment horizon, and if he gets 1.5% extra return over the bank FD over that 25 years, and then if you break it down, if you invest 1 crore for 10 years and you get 1.5% return extra, you make 15 lakhs extra. If you do the same thing for 20 years, you make 30 lakhs extra. If you make the same thing for 25 years, you make with a compounding effect about 40 lakhs extra. So just by taking a good investment decision based on proper analysis, you make 40% extra wealth on the debt component over the investment horizon. Now, when it comes to debt, I think people become so overly obsessive about the safety that they don't think of these dramatic differences in the ultimate realized wealth. And therefore, I think that's where the problem comes. The challenge is for the investors to educate themselves. The challenge is for the industry to educate them. Now, there is a lot of bitter experience as we understand from the investors when they have either invested in credit funds or in uh, duration funds. Now, the challenge is that if you look at the total industry debt AUM, it's a very small fraction of the total debt AUM which has suffered some casualty, and that too in the last 1 or 2 years on the credit side, because people simply make wrong choice. As I said in the beginning, that look, when you invest in debt, all your return calculations are invalidated if the person to whom you lend the money does not return your money on time. And in every other walk of life, people will take a smart decision and deal with the better people, stronger people, higher quality people. So why, when you come to debt, you have to invest in poor quality credit or aggressive credit to make that 1.5% extra return? Because ultimately, in an economic cycle, whenever there is one difficult period, the weaker companies are most likely to succumb to the difficulties. And therefore, I think the key to successful investing in debt is to eliminate unwarranted credit risk in your portfolio, because if your money does not come back, it doesn't matter how you invest. And those are some of the parameters that people need to get educated about. We have always said in every single interaction which I had with anyone that credit risk is permanent and market risk is temporary, which means if you encounter a credit situation, the likely recovery is very, very poor. But if you get trapped in an interest rate volatility, because these are so closely watched and monitored by the central banks and the government, and these are cyclical in nature, uh, you will get out, healthy if you remain invested for a long enough time. So the only thing when you invest in an interest rate product that you need to have on your side is time and nothing else. And those are some of the basics of debt investing for which unfortunately there isn't adequate awareness. I am sure that the uh, awareness is increasing by leaps and bounds, and some of the recent episodes have made people very, very aware. Now, the second point is on the interest rate volatility. Uh, People say that we will take our interest rate call and all that. I think that's again a very naive thought process. Let me just give you one example. In the last 3 years, interest rates have come down so significantly. We are at historically low interest rates, and the gilt funds of all the funds have given fantastic return. But we haven't seen even a drop of money coming into those funds in the last 2 and 3 years. So I think people overestimate their ability to understand the debt markets or the interest rate directions. And that happens because people don't know what will happen. I mean, 3 months back, nobody knew that coronavirus will completely upset the global order in terms of the economics or politics. So people try to project 3 or 5 year where we have no clue as to what will happen. And that's where I come back to the flexible investment strategy. Rather than trying to be 100% sure about future, let the future tell us what is going to happen, and then keep your investment strategy flexible, change your portfolio as and when the things change. So that's how I think one needs to evaluate the debt space and allocate investments.
Right. So there you have it. So As it turns out, these banking and PSU funds can serve as a great alternative, and they can add some value to your portfolio. You should do your asset allocation right. You should invest according to your risk profile. You should do your homework, and if you do all that, you can make most of your money. Thank you so much, Mr. Jaju, for your time. It was a pleasure talking to you.
So before I end, I would like to say that we are fund managers regulated by SEBI. So whatever I have said here, people should read it in context and in conjunction with the disclosures and disclaimers which are there in our all scheme of documents and on our website. So just please keep that in mind. Thank you so much for inviting me today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.